all, I would like to wish congratulations to our all the aspirants who have cleared their AFM and PPB exam as well as their IE and IFS exam. And these are some of this many scores, many aspirants' names that have cleared with such good scores. Good evening, good evening, good evening, everyone. So today, finally, we have just one more paper left, the RBWM paper. Once we clear it, we'll be able to qualify our JAIIB exam. So one last lap, one last time, let us give it our 100% and clear the RBWM paper. So we'll be starting with the module A today. Everyone who's present here, please mark your presence. Do let me know whether the audio and video is fine. Everyone, those who have joined us from the YouTube platform and the paid platform, please mark your presence. This is a live class and everything is fine. All right. If you do not understand any term, if you want me to repeat anything, do let me know. All right. Very quickly join the session. All is fine, fine, great. So are we ready? Shall we start with the class? Shall we start with the module A? Give me a confirmation. Yes. Okay. So when we are talking about the module A is all about the introduction to retail banking, role, the models, concepts, distinction between retail and corporate banking, and the concept of branch profitability, profit and profitability. So let us start with the first unit of our module A, which is introduction to retail banking. This unit basically covers the meaning of retail banking, characteristics, advantages, disadvantages, evolution of retail banking, challenges for retail banking in India. All right. So what is retail banking? Retail banking is also known as individual banking, where the banking products and services are provided to individual customers for non-entrepreneurial purposes, for non-business purposes. Some business purposes are also there, but that is only for the small businesses or the MSME or agriculture. Right now, focus on the capsule batch, all right? And I would suggest that let us keep these questions for the end. Focus on whatever we are studying right now today. Okay. So when we are talking about retail banking, it provides all the products on the asset side, on the liability side, even as on the third party product. So fixed deposit, liability side, mortgages, loans, para banking services like insurance product, mutual fund product, everything is provided to the customer, that is individual customer. Okay. Corporate banking is dealing with wholesale banking, that is businesses, entrepreneurial purposes. But when we are talking about retail banking, it is focused on individuals only, right? It is focused on individuals only. Now there are two stages in retail banking: mass retail banking and class retail banking. Mass retail banking is the first stage that we start with. The bank provides standardized banking products and services. So each and every customer that comes to the bank with any requirement, any product or any service, bank is going to provide them the same product. The main goal of this stage is to build a broad customer base to serve as a stable source of funding, right? Standardized products and services to all the customers. These are the generic products like a savings bank account, generic product. Every customer is offered the same standardized generic product. This is the first stage. Now from these customers, the banks select the high net worth individuals, customers that are profitable to the banks, customers that are going to yield profit, who are able to avail the fee-based services. Then the bank enters into class retail banking, where the bank provides customized products. Customized products means tailor-made products targeted at a niche customer segment. This niche customer segment are the high net worth individuals, right? So every retail bank, it starts with mass retail banking. The aim of this stage is to get a large customer base. From this large customer base, then the bank select the high net worth individuals, niche customer segment, who will be able to avail high fee based services that will bring profit to the customers. That is great. Many, many congratulations. All right. So, high net worth individuals. Now, if the bank is focusing solely at the niche customer segment, then we are calling it private banking. When the focus of the bank is only on the high net worth individuals, then it is called private banking. So three terms, we have come across three terms: mass retail banking, standardized products and services to a large customer base; class retail banking, customized products and services to the niche customer, high net worth individuals; and then private banking, when retail banking is focused only on the high net worth segment, when the bank is providing products only to the niche customer segment, then it is known as what? It is known as private banking. All right, private banking. This is the basics. What are the features or characteristics of retail banking? Targeted at individual customers or small organizations. Aim is to meet the need of large number of customers that have diversified portfolio. Retail banking focuses on multiple products, multiple customer segment, and they also focus on multiple channels, right? Multiple products on asset side, liability side, third party product; multiple customers, customers who belong to the affluent class, to the high net worth individuals, to the low income group; as well as multiple channels, physical offline channels, branches, business correspondents are also there; digital channels, online banking, mobile banking is also there, right? It offers different liability, asset, plethora of services. Delivery model is both physical and virtual. Services are extended to small and medium size businesses as well. So these are the main characteristics of retail banking, right? Retail banking. Okay. So I hope the meaning of retail banking is clear. What does retail banking provide is clear. It offers all the products: current account, savings account, mortgages, personal loans, to individual customers rather than large institutions. The banks, they could be local community banks, or it could be divisions of large commercial banks as well. General public. General public. Demo means that today and tomorrow you will be having the class. You will be able to see the class on YouTube as well. After that, day after tomorrow, all the classes will be only on the Oliveboard platform. Okay, so these are the features of retail banking. Now we move on to the evolution of retail banking. See, retail banking is not a very old concept in India. After independence, the focus of banks was only on the corporate clients. Later on, when some foreign sector banks they entered, private banks they introduced the retail banking product, then the Indian banks, public sector banks also understood that the need of the customers, need of the public is different. So when we talk about the evolution of retail banking, the trend started in the late 1970 and 1980. Foreign banks set this trend in India. They brought to India the consumer banking model, hybrid liability and asset product. Two banks name that you need to remember that started the retail banking trend in India: Standard Chartered Bank and Grindlays Banks. They were the starters. They were the pioneers in introducing the retail products in India. Then we had Citibank, which introduced the credit card products in 1980s. If we talk about the Indian banks, so SBI, Indian Overseas Bank, Bank of Baroda, Bank of India, Andhra Bank. They started developing and marketing their card products. In fact, when we talk about the Indian banks, then Bank of Baroda and Andhra Bank were the two early players. Two early players. So if the institute asks you, they usually in every exam cycle this is asked. The trend setters of retail banking in India, foreign banks, Standard Chartered Bank, Grindlays Bank. When they specifically ask you about Indian banks, then you will mark SBI, Indian Overseas Bank, BOB, Andhra Bank, and BOI. All right. This is the evolution of retail banking in India, right? Then obviously we had the IT revolution, ATMs were introduced, the NBFC's co-lending model was introduced, then digital banking, mobile banking, online banking. Now the scenario of retail banking has completely changed. What are the prerequisites for the success of retail banking? What should the banks must have? Only then their retail banking model will be successful. There should be an efficient delivery mechanism. The customers, they are not limited to physical channels or digital channels only. They want both. They want a blend of offline as well as online modes. They want to avail banking products and services anytime, anywhere, anyway. Triple A. Anytime I want to transfer funds, I want to make credit, or I want to make a payment, I can do it anytime. I need not visit the ATM or the bank to withdraw cash. Anytime, anywhere, anyway. All options should be available. Direct banking, it is the fastest growing and dominant channel of the future. Product appropriateness is important. We'll be studying in the next module the 7 P's that would make retail banking a success, like price, product, promotion, place. Everything should be appropriate. There should be proper scoring models for assessing the credit worthiness. Only then the bank should give the loan, approve the loan, right? Otherwise, NPAs will rise, and there should be a consumer protection environment. Consumers' data should be kept confidential. There should not be data breaches, or there should not be identity theft, right? So, these are the prerequisites for success of retail banking. What are the challenges for retail banking? Challenges for retail banking. There should be consumer protection in pricing. In today's technological era, there are so many ways in which the customer's data can be hacked. So a proper encryption method, consumer protection method should be there. If there is inadequacy of management information system, that could lead to failure. There should be a good understanding of the KYC and AML issues by the bank, managing all the types of risk, market risk, the credit risk, effects of disruptive new technology, and continuing growth. These are the challenges that retail banks face. These are the challenges that they have to tackle, right? Future of retail banking, what we are going to see in the near future, there will be growth in digital banking. People are shifting from physical channels to online channels. Rapid adaptation of blockchain by retail bankers, artificial intelligence, data science in banking, cyber security, payment innovations, and we'll be seeing rise of big tech in the banking industry. We are right now also we are seeing many tech giants like Google, Apple. They are entering the banking scenario, the financial scenario. They are offering banking products and services. All right. So these are the things that we are going to see in the future. What are the advantages of retail banking? Retail banking has advantages both for the client as well as the bank. Clients, they get diversified products and services through multiple channels anytime, anywhere. The fees is also lower. Client base, for the bank, the client base will be large. Risk is widespread. When the bank is offering their products to thousands of customers, even if a few default, still the bank will be in a profitable scenario. Customer loyalty will be strong. Customers, they do not shift from one bank to another very easily. They do not change one bank. If a customer is already availing a deposit product from bank XYZ, there are more chances that they will approach the same bank for a loan as well, because they trust the bank and their services. Attractive and wide interest spreads. Customer base is too fragmented. They cannot bargain effectively. So the bank can offer any rate of interest. They can charge any rate of interest subject to obviously the RBI guidelines. And the risk is also well diversified because the loan amounts are very small. All right. That is all from our unit 1. We have completed our unit 1. It was very basic unit, simple unit, and just the meaning, features of retail banking have been covered. Till here, if you have any doubts, any queries, any questions, then you can ask. Everyone who is present here, kindly like the video. Who have joined us on the YouTube channel, like the video, share the video. If you have any doubts, do ask. Okay, you applied in April 2024. It was your first attempt. May 2026 is second attempt. I cleared IEIFS. Now I cleared AFM and PPB. Is my 3 years over? No, you have another year. You can give your attempt in this November cycle, sorry, in this May cycle as well, and November. Okay. What's the class timing? 7 p.m. daily. 7 p.m. daily. Okay, and we are trying to finish our module 8 today, so we can expect the class to go on till 9. Module A is very simple, very short. 2.5 hours are enough to complete the module. Everything is clear till here? Everything is clear? Naveen, Sakti, Anmol, everyone clear? Arjun? Okay. Now we are starting with the next unit, retail banking, role within bank operations. Very, very, very important topic. Definitely you will see 2-3 questions asked from this unit. We have studied about the approaches. We have studied about the business models. So banks, they follow different approaches for their retail banking activities. Right, the different models that are adopted by banks, it depends upon the importance they give to retail banking. If the bank wants to convey their image as a completely retail bank, they will go with a separate approach. If, however, they are just offering retail products as a part of their overall strategy, then a different approach will be used. Right, the models adopted by banks, they vary among the public sector banks, private sector banks, and the foreign banks, even among the new generation and old generation private bank. So there are 3 main approaches which are followed by banks: the strategic business unit approach, SBU approach, departmental approach, and integrated approach. Strategic business unit means the bank wants to convey itself that it is a retail bank. The main focus of the bank is individual customers. This is what the bank is trying to show. Departmental approach also gives importance to retail banking, but less than SBU. It does give importance, but less than SBU. Integrated approach thinks that we should have a unified approach. Overall business plan, retail products should not be sold as a separate approach. We should not set up a separate branch for retail banking. Part of the overall business plan. So let us understand these approaches one by one. First, we have the SBU approach. Let us say there's a bank XYZ, right? And it has set up separate unit. One unit is for their corporate banking. Another unit is for their, let's say, agricultural banking. Another unit is set up for their retail banking. So each of these units are independent. They are completely independent. They will have their own management structure. They will decide their own pricing, product, promotion, everything. Each of these units are separate, independent, right? So the SBU approach aims at dividing the business on lines of strategic business unit. So here retail banking is given quite high importance, right? They are autonomous division. Autonomous means independent. They are small enough to be flexible, large enough to exercise control over most of the factors. They're large enough to exercise control over all the factors affecting their long-term performance: price, product, promotion, place, people, everything. So these are profit centers. Profit center. The main aim of the retail SBU will be to generate profit on the retail banking side. It can be a unit of a large corporation, or it can be a business itself, right? A subsidiary can also be set up by the bank, or if the bank wants, it can be a part of it. The retail banking division, it can be a part of it. If we talk about example of SBU, there are many Indian companies that are following the SBU example. There is a parent company like the Reliance Industries is there, and they're working in different segments like the petrochemicals, retail, telecom. Each of the unit is separate. The telecom unit is not going to interfere with the decision making of the petrochemicals. Similarly, we have the Aditya Birla Group. They have separate units: capital, fashion, chemicals. Each of the units are separate. ITC is working in foods, personal care, cigarettes as well, right? So that is the example of SBU approach. Banks, they also set up different separate branches. Okay. So when we talk about the SBU approach, large public sector banks, they follow it. Top 5 public sector banks, they follow the approach. New generation private sector banks also follow the SBU approach since the very beginning. They have a clear focus on their business objective. They want to be in the top slot across all the types of banking. That is why they give more autonomy and independence to their retail banking segment. In foreign banks also, SBU model is followed. Now, how the questions will be asked by the institute? Institute will ask you that there's a bank XYZ that has set up profit centers focusing only on retail banking. The profit center is given complete autonomy to decide everything. They are small enough to be flexible, large enough to control everything. Which type of model are we talking about? So you need to keep the key terms in mind. Or the institute might ask you, which type of model followed by banks is a management by objective? So you need to remember it is the SBU. Alright. Each unit will have its own discrete marketing plan, specific product, and specific market segment. Goal is to achieve targeted profit, and if they're not able to achieve the goal, they will knock down the module. They will shut down their retail bank. All right. So that is the meaning of a strategic business unit. When we talk about departmental approach, the name itself tells us the organization is divided here also. The business is divided here also. But separate units are not set up. For retail banking, a separate unit will not be set up. The same team is going to perform functions for all the types of banking. So there's the bank XYZ. It will have its accounting team, the marketing team will be there, then there will be the finance team. All of these teams will prepare the plans for all the types of banking. A separate unit for retail banking is not set up. So division is there in departmental approach. Rather than dividing on strategic or business line, the organization is divided on the basis of functions that the teams perform. Again, the institute will give you a scenario. XYZ bank is there in India, and they are dividing the organization into the various departments. They're following the functional approach. Which type of model are we talking about? So here we are talking about the departmental approach. It is a specialized functional approach within an organization. The various functions are divided, like there's the accounting team, marketing team, finance team, as well as the planning team. Each department will have its own manager and chain of command, like the banks that you are working in. Many of you would be working in public sector banks, so you'll be seeing there's the asset department, loan separate from the deposit liability side, separate from the credit department, insurance department, right? So separate departments are set up, but they will take the decision for all the types of banking. So public sector banks in India generally adopt the departmental approach. It is a general approach. Retail banking is just one of the business model. It is not a focused separate business model. In SBU, retail banking is a separate model, but in the departmental approach, it is part of the pure organization. The parent organization is not divided into separate units, right? So that is the departmental approach. It is a functional approach. Okay, clear? The difference between departmental approach and the SBU approach. So this is the oldest form of public enterprise. It is the oldest form of public enterprise, like in Indian Railways also, or in India Post also. Departmental approach is used. There is financial dependence, management, accountability, and strategic control is there. The parent organization is controlling and supervising each and everything. Which type of banks have generally adopted the departmental approach? It is the public sector banks. They have generally adopted the departmental approach as their retail banking business model. Old generation private sector banks as well. So retail banking is a part of the overall business plan. It is not done as a separate departmental activity, right? Retail banking is not even a separate departmental activity. In SBU, profit center is set up. In departmental approach, it is treated as a part of the business, right? And the third approach is integrated approach adopted by smaller businesses. This approach is not seen in Indian banks. It is for a new business, maybe an MSME that has just started and they want to lay a firm ground. So it combines all socio-economic aspects, adopt a cohesive approach to tackle problems of the business. It is assumed that having a unified business would reduce the risk. So in SBU, profit centers are set up. In departmental approach, different departments are set up. In integrated approach, you will see neither profit centers nor separate departments. They function through scale. Scale means quantity. If they increase their quantity, the profit will increase. The profitability will increase. That is the main aim of integrated approach. All right. So these are the three types of approaches which are followed in India in different types of banks. Now, if we talk about the business model, in private banks, they have a clear positioning platform, right? In public sector banks also, they have a positioning platform. Positioning means how they want to portray themselves, right? In old generation private banks, they have a clear positioning platform, overall business plan in line with their size and scale. So old generation private banks, that is why they go with the departmental approach. New generation private banks want to be in the top slot across all class of bank. That is why they go with the SBU approach. They are very aggressive in promoting their products, in reaching out to the customers, using technology, strategy, business initiative, right? They want to have profit across all the segments. That is why the new generation private banks, they go with the SBU approach. Foreign banks, however, they do not have any positioning objective. They do have SBU approach, but it is based on profit. business objective. They will enter a particular segment if it is profitable, and if it turns out to be not profitable, or the foreign banks are not able to convert the efforts into final goal, they will shut down the segment. They will exit the segment or exit a particular business line. So that is the approach of the foreign bank. That is why foreign banks, they do not want to scale. They do not have too many branches. For example, there is the BNP Paribas. It entered the retail banking space very aggressively in the 1990s. But they found that the retail banking was not profitable. Similarly, American Express Bank has also came out of their credit card business. Citibank has also quit their retail business in India. Public sector banks, they cannot shut down so easily because RBI guidelines are there, plus they are offering products to the general public. Government rules are there, they're governed by the Banking Regulation Act, RBI Act. More restrictions are there. That is why the public sector banks, they cannot go by complete profit objective. Foreign banks, they do. Foreign banks, they go by profit objective. If it is not profitable, they will shut down the segment. All right. That is all. We have completed the second unit as well. All right. The second unit is also done. All the three approaches are clear. The SBU approach, departmental approach, and the integrated approach. If you have any doubts, any queries, any questions till here, then you can ask. Any questions? Everyone who is here on the paid platform or on the YouTube, if everything is clear or not. Business unit not cleared. SBU. Do you want me to explain the SBU approach again? Okay, let us go through it once more. See, what happens in the SBU approach? Let us say that this is the bank. This is the business unit XYZ bank, right? XYZ bank. It is using the strategic business unit approach. It will set up separate profit centers. So the corporate banking side will be separate. It will be as a separate profit center, separate unit. And retail banking will be a separate unit. It could be a branch, right? Like SBI has its retail branches, right? Retail branches and corporate branches. Okay. So each of these branches will have its own discrete marketing plan. The corporate banking branch will follow its own plan, own process, promotion strategy, pricing strategy, everything, right? And it is not going to depend on what is the strategy of retail banking branch. Similarly, the retail banking branch will focus on generating profit on retail side only. They will not depend on what the corporate is following, what the corporate branch is following, right? So that is the SBU approach. SBU approach clear now? Is the SBU approach clear now? Is it clear? Then let us move on to the integrated approach then. We can say SBU is a mini company within a larger bank. It has its own mission, own goals. Like SBI uses specialized units, project finance and structuring SBU, PF and SBU to manage specific infrastructure, project finance needs, right? That is the SBU approach. Clear now? Is SBU cleared? Then we'll move on to the integrated. Yes? Okay. If we talk about the integrated approach, it has a central system. It connects all the account balances, loan details across all the customer channels. There are the APIs. Banks connect with all the customers on the same platform. Okay, that is the integrated approach, having a cohesive framework and unified business. The core banking is merged all together. We are not dividing the organization in any manner, neither on the basis of profit nor on the basis of function. Integrated approach is not as such followed in Indian banks. I told you, right? It is not followed in Indian banks as such. Okay? It is an old model, we can say, for new businesses. But for example, um, let's say some banks, they use integrated approach for their ATM cash distribution, right? But as such, any bank is not completely following the integrated approach, not completely following the integrated approach. Then if we talk about the departmental branch, SBI obviously is a very large bank, that is why they are following the SBU approach. Otherwise, commonly departmental approach is used by the public sector banks, right? The public sector banks. If I tell you the difference, departmental approach, retail banking, the bank operations are organized into separate functional department, marketing department, credit department, operational department, rather than fully independent business unit. Okay. In SBU approach, retail is treated as an autonomous profit center. It has its own balance sheet, right? The departmental approach keeps it under the general agenda. SBU approach has its own balance sheet for retail banking. Integrated approach consolidates all the services at the branch level. At the branch level. Okay. In public sector banks, they follow the same SBU. Most of the public sector banks, the most common model followed by public sector banks is the departmental approach. But some very large public sector banks also follow the SBU approach, like I gave you the example of SBI, right? Other than that, private sector banks, they follow the SBU, the strategic business unit. All right. Whether integrated approach is called hybrid approach. No, integrated approach is, we cannot say it is a mixture of SBU or departmental, not like that. It is a separate model. It is a separate model keeping everything unified under one umbrella, not dividing the organization at all. Business models that are followed by the different banks that you're asking. So business model means positioning. Like if I want to position myself, I want to advertise myself, I want my image to be created in the market in a particular manner. That is known as positioning platform, right? So old generation private banks, they have a clear positioning platform. All they want is to be in the top slot, not just in terms of profit, but also in terms of popularity. So they offer competitive products. They do advertising of the products. You don't see public sector banks advertising their products, do you? No. But on TV, radio, newspapers, even banners, you see public sector banks advertising their insurance products or mutual fund products or loan products. They're very aggressive. If they see that one bank has changed their interest rate, they will also change it, right? So new generation private sector banks, they want to be in the top slot. So they go with aggressive positioning. Old generation private banks and public sector banks, they want stability. They want stability and regularity. So they will be in all the segments, not just focusing on profit or profitability or popularity, right? Their focus is to provide welfare to the public as well. They're regulated by the government and the RBI more as compared to the private banks and the foreign banks. And if we talk about the foreign banks, they completely focus on profit, business objective. They will enter a particular banking segment, retail banking or corporate banking, if it is profitable. And if it turns out to be non-profitable, they will exit the segment. They will not stay in the segment any longer. They will shut down the module. Clear now? So just try to frame the questions. Try to keep the questions in your mind. You need to remember the characteristics of each of these approaches. What is done in the SBU approach? Terms that you need to remember: profit center, autonomous unit, independent, flexible, right? These are the features of the SBU approach. Management by objective. Okay. If we talk about the departmental approach, you need to remember function. Organization is divided into the various departments according to the functions that they perform, rather than any separate unit. Like the marketing function is there, accounting function is there, right? And for the integrated, you need to remember the term unified business. Unified business. Clear now? Which type of bank follows which type of approach, that also can be asked. All right. Okay, so now let us start with the unit 3. We will cover the unit 3 now. Applicability of retail banking concepts. Here all you need to remember is the business process structure. We have studied about the horizontal model, vertical model, predominantly horizontal and predominantly vertical model. We have studied this, right? This depends on what basis the organization follows these different models. So retail banking is characterized by 3 characteristics: multiple products, deposit products, loan products, cards, insurance, investment. Multiple products are offered by retail banks. Multiple channels of distribution. Banks that are not limited to only physical branches, but call centers, internet, mobile banking, kiosk, business correspondent, business facilitators. Multiple channels of distribution are there, and multiple customer groups are there. There are individual consumers, small businesses, as well as corporate clients like MSME clients, very small businesses. Under the consumer also, individual customers also, there will be the affluent class, there will be the super affluent class, high net worth individuals, the mass market, class market, private banking. Different customer groups are there, multiple customer groups are there. Okay. There is another term which is known as in-house and outsourcing. Two terms are there: in-house and outsourcing. In-house means using your own resources. The bank is using their own resources in terms of technology, or in terms of the officers, in terms of the customer approach, right? The officers or the bank staff itself is reaching out to the customer. They are themselves doing the marketing. Bank has its own marketing team, technology team. Everything is present within the bank. That is known as in-house. So using the own resources means in-house sourcing. Outsourcing means maybe hiring some services, right? Using agents, direct selling agents for their particular business. So outsourcing means using third party service providers. For example, if the bank wants to reach out to the customers, they want to make the customers aware about some new credit card product that they have launched, they will, rather than involving their own staff or the officers, they will reach out to the direct selling agent, the direct selling agency, call centers, who will call the customers, tell them about the product. Once the customer is interested, the rest of the process will be done by the bank. That is an example of outsourcing. So most of the public sector banks, they use their own resources, in-house resources for retail banking. For some activities like ATMs, credit card, debit card, they outsource it because in-house facilities. In reaching out the customers, mostly people are required. More number of staff is required. And if the original staff is working in this segment, their time will get wasted. They can focus, they can utilize the skill of their own officers and staff in better areas. So for ATMs, credit cards and debit cards, outsourcing is used by the public sector banks. What is the major reason for this? Regulatory prescriptions. RBI has placed strict rules and guidelines on appointing direct selling agents. They should have cleared the direct selling agent examination. They should have training. Qualified agents should be appointed by the banks. And there should be proper supervision of those who are reaching out to the customers, even for the recovery agents. In old private sector banks also, they use in-house resources. New generation private banks, they have a balanced mix of outsourcing and in-house. A little skewed towards outsourcing means they prefer outsourcing, but they also use in-house resources, right? New generation private bank, they prefer outsourcing, but they also use the in-house sources. Some products like asset could be outsourced. Liability is not outsourced, centrally processed. Foreign sector banks, again, they use the outsourced model because they do not have a good presence. They do not have many branches in India. In some foreign banks, both front end and back end operations. Now, what are front end operations? Where there is direct dealing with the customers, that is front end operations. Back end operations could be technology, right? Keeping of the records, that is also outsourced. In other foreign banks, back end could be outsourced, while the front end operations like sourcing of the HNI clients, high net worth clients, could be done through in-house resources. All right. So this is the applicability of the retail banking concept, right? In-house and outsourcing. Other than this, what is asked by the institute in your exam is the four models, the broad classification based on technology and customer interface capability. Now, when the banks, they are using in-house sourcing, right? They're using their own resources. So whether they have developed process models for each product line separately, or they have a centralized process for all the products. So the Boston Consulting Group had conducted a study and they broadly defined four process models: horizontally organized model, vertically organized model, predominantly vertically organized model, and predominantly horizontally organized model. Listen very carefully. Try to understand this concept. I will draw a scale for you. On the extremes, we have the vertically organized model and the horizontally organized model. In between, we have the predominantly vertical model and predominantly horizontal model. Now, this depends on whether there is a centralized customer database or a process model used across products for all the products, or separate process model for all the products. If the bank has a centralized database, then it is known as a vertical model, right? However, if it is having a separate process model for all the product line, then it is a horizontal model. These are the terms that you need to remember. So vertical model, we can say it is customer centric. Customer centric. So if let's say a customer availed a deposit product and they gave some information, it is stored in the centralized database of the bank. The bank will use this information to tell them about the asset side product as well. So for the asset side, liability side, third party product, everywhere there's a common customer centralized database. That is the vertical model. Horizontal model, on the other hand, for the asset side, separate database, for the liability side, separate database, and for other product lines, separate database. So we can say that the horizontal model is product oriented. Product oriented. So if there are, for example, 10 products that the bank is offering, for all of these 10 products, there's the same customer database and process model being used. It is the vertical model. If for all the 10 product line, different database and process is used, it is the horizontal model. Predominantly vertical and predominantly horizontal means, for example, out of 10, 8 products have a customer database, common customer interface. It is the predominantly vertical. Maximum vertical, mostly vertical. For a few products, one or two products, product oriented or horizontal could be followed. That is predominantly vertical model. Predominantly horizontal means only, for example, let's say for 2 products, a common customer base is there. For the remaining products, it is product oriented, separate database and separate process model. Then it is known as predominantly horizontal. All right. So these are the 4 types of model. They depend on what? They depend upon the customer information available in a single platform in the database side for offering multiple products and services across assets, liabilities, and other services. So if the bank has a common customer database, customer information is available in a single platform for all the multiple products and services, then it is the vertical model. It provides functionality across product, customer database orientation, centralized customer database is used. That is why we call it a centralized model or customer focused model. Horizontally organized model, however, uses different process models for different products, offering end-to-end solution product wise. So for each and every product line, they will have a separate customer database and separate process model. Process model means in-house or outsourcing. Clear? Give me a confirmation whether the horizontally organized and vertically organized model is clear or not. Everyone. You need to remember these key terms. Common customer database. If it is available, vertical. If it is not available, product centered end-to-end processing, it is horizontal. Clear? Okay, others also, everyone clear? All right. YouTube also, all those who are here on the YouTube channel, if you have any doubts, you can ask. Okay. Now, what is the predominantly horizontal and predominantly vertical model? It customer information only for some products, mostly product oriented with common customer information for some products only. Out of 10, 8 are having a end-to-end processing. For 2 products, common customer information is used. Predominantly vertically organized model, on the other hand, common information is available for most of the products. For a few products, end-to-end processing can be done. Right? Okay. This is the meaning of the 4 models that have been defined by the Boston Consulting Group. Now, which class of bank follow which type of model? Let me tell you one thing. If you read something and you think that, oh, this is old fashioned or it is traditional, then easily you can identify that this is used by public sector bank, right? For example, the departmental approach was used by public sector bank. It is traditional, quite common. On the other hand, SBU sounds something which is tech savvy. It is something that the new generation would prefer, right? So they follow the SBU approach. Similarly, if the bank is having a common customer database, centralized customer database, it means that they have a good technology. They are able to use it, the customer information in various product line, right? And in the predominantly horizontal, it is traditional, or in the horizontal, it is traditional. Banks, they do not have the capability to use the information system. This is just a way to understand it. So that would be used by the public sector banks. So in most of the public sector banks, horizontally organized model is the standard bank. Not normally, public sector banks, they follow the horizontal model. Obviously, in some of the banks, predominantly horizontal model can be used, right? So public sector banks will either follow the horizontal model or the predominantly horizontal model. In old private sector banks, the scenario is mixed, right? Mostly we can say it is predominantly horizontal or predominantly vertical somewhere. New generation private banks, they follow a vertically organized model. Foreign banks also follow a predominantly vertically organized model. So common customer information is available across the various products. So these are the four: predominantly horizontal and vertical. It is a balance, right? We can say it is not completely horizontal, not completely vertical. Like when we talk about political scenarios, right? Whether we are left inclined or whether we are right inclined. Some people are central. They follow a mix. So the predominantly vertical model and the predominantly horizontal model, some of the features of horizontal model, some of the features of the vertical model is followed. Yes, it is predominantly vertical. In today's time, most of the large banks are going with the predominantly vertical model. But generally, traditionally, horizontal model was followed by the public sector banks. SBI is the largest bank, so obviously it will have the benefits of technology and other services. Okay, so predominantly horizontal and predominantly vertical means predominantly horizontal, mostly horizontal. For most of the products, end to end product, end to end solution will be there. End to end solution will be there in predominantly horizontal. In predominantly vertical, mostly for most of the products, common customer information is available, and for a few products, end to end processing could be done. That is the meaning of predominantly horizontal and predominantly vertical. Clear now? Is it clear now? Yes, everyone? Okay. Another way of defining the domains or business approach by banks is segmented approach, geographical approach, and classification based approach. Now, this is not asked very frequently by the institute. The institute basically asks you about the horizontal vertical model or the SBU approach. This is not very common, but let us go through it. So, the segmented approach. The branches are classified based on the business potential with regard to the retail space. So we can say the branches could be resource centers who bring in the customers, profit centers, priority centers, general centers. Branches are positioned as resource center. They are part of the overall segmentation game plan of the bank. Public sector banks, they have a very large network, they have many branches, so they can design or decode some branches as resource centers, some as priority centers, some as general centers. They have a clear business focus. That is the segmented model, right? branches, segments of branches with focused marketing strategy. Second, we have the geography based approach, which is according to the region. It could be a hilly region, or it could be a desert region, or it could be somewhere in the south of India. So the retail models are built on the basis of geography. The needs of the people who are living in a hilly area will be different from the people who are living in the coastal region. So accordingly, the retail models are built, right? The language which is used in the south of India will be different from the language that the people in the north of India understand. So accordingly, the retail model will be built. This is the geography based approach. According to the state, district, the branches are, they are created. The model is created. That is the geography based approach. The most common approach followed by banks, however, is the classification based approach. Whether it is a rural branch, semi-urban branch, urban branch, or metro branch, right? Public sector banks today have not developed their business model on basis of this. However, they follow a holistic model, a balance of classification, geography, and the segmented approach. All right. So segmentation means on the basis of marketing strategy. Each branch is given a separate strategy. Geography based approach means the area in which the branch is situated, the location, part of India. And classification based approach, whether it is a rural branch, semi-urban branch, urban branch, or metro branch, right? Now, this chapter also includes what model is used by banks for their technology, for their liability products, but that is not important. All right, that is not at all important, so do not worry about it. Here I have presented everything in the table. Whatever we have followed, studied till now is given in the table. For example, what is the model used by public sector banks for product development? They use in-house resources incorporating the market dynamics. Old generation banks also in-house independently. New generation private banks in-house independently. But foreign sector banks, they outsource their product development. Product processing, public sector banks, standalone model. Now, what is the standalone model? There are two types of models, centralized model and the standalone model. We'll be studying about it in the module B. Centralized model means there is a main branch at the center and various profit centers, resource centers are associated with it. So the resource centers will onboard the customer, the preliminary documentation can be done, and then once the customer information is collected, they forward it to the retail processing center or the retail hub, the main branch. That is the centralized model. So many branches are integrally connected to each other. Standalone model, on the other hand, it is independently. Everything is done at the branch. Customer sources, marketing, KYC, AML, monitoring of the loan, disbursement of the loan, sanctioning of the loan. Everything, recovery itself is done at the branch. That is the standardized model. So, public sector banks, standalone model. Old generation private banks also standalone model. New generation private banks and the foreign banks, they use the centralized model. You will be studying about it in the module B in detail. For technology, the public sector banks, they use in-house model with partial outsourcing, for example, for ATMs and credit card. For old generation private banks, they go with outsourced model. New generation bank, they have a balanced mix. Foreign banks also use outsourcing. Pricing is market driven and competitive. Public sector banks, they cannot use their complete autonomy for pricing the product. They have to follow whatever is going on in the market, whatever is stipulated by RBI. Old generation private banks are slightly aggressive in their pricing strategy, However, new generation banks and foreign sector banks are very competitive. They are very aggressive. Implementation model used by public sector bank will be horizontal or predominantly horizontal. Old generation banks will go with a blend of predominantly horizontal and vertical. New generation private banks are mostly vertically organized, and foreign banks are predominantly vertical. All right. So the remaining part of the chapter, whole paragraphs are given. You need not worry about it. All of it I have put in a concise form in this table. So go through this table and it is enough for you to understand the unit 3, right? And we are done. No, we have the distinction between retail and corporate banking. What is the difference between retail and corporate banking is also a very frequently asked question. Frequently it is asked in your exam. So retail banking targets at the individual segment. Corporate banking deals mainly with the corporate clients. Retail banking is a mass market banking model. It focuses on the large customer base. Wholesale or corporate banking looks at the smaller segment, business or the corporate client. There are more number of clients on the retail banking side as compared to the corporate banking side. Retail banking is a business to customer approach. Bank is the business and they are providing the products and services to the customer. Corporate banking is a business to business approach. Bank is a business. They are providing the products and services to another business, corporate client. The ticket size of loans in retail banking is low. The quantum of loan in retail banking is low. For example, if I am taking an education loan or a home loan or a car loan, it will not be very high. But the ticket size is very high in corporate loans. It is for running a business, starting a new venture, expanding the business. So the quantum of loan will also be more, right? Then risk is widespread in retail banking because the customer base is large. But in corporate banking, the risk is limited because the ticket size is also big and the customer base is also relatively small. So the risk is concentrated, right? The risk is widespread means even if a few customers default, the bank is not going to face too much loss in retail banking because the ticket size is also small. But in corporate banking, the effect and loss will be more. Returns are more in retail banking because the spreads are more. The customers of retail banking, they cannot bargain for a lower rate of interest on loan or a higher rate of interest on the deposit because they're too fragmented. But in corporate banking, the customers are availing a higher loan so they can bargain for lower rates, right? Also, the customer base is small. Monitoring and recovery in retail asset is more laborious because of large customer, but it is less in as compared to the corporate banking. In liability side, the cost of deposit is relatively less in the retail side as the ticket size is small. But in corporate banking, at once the corporate customer, they deposit a large amount of money. So the cost of maintaining the deposit will also be high. There will be pressure from the corporate for higher rate, competitive forces. They want to have higher return, interest on their deposit. Impact of NPA will be more in corporate banking as compared to retail banking because the size is more in corporate banking. All right. How will the institute ask you? Institute will ask you a multiple selection question, right? They will give you these multiple statements, 5 or 6 statements. You'll have to identify which of those statements correctly define the difference between retail banking and corporate banking. Or the institute will give you a scenario about a retail bank and a corporate bank. The institute will ask you to identify what will be the advantage of retail bank, what will be the advantage of corporate bank. All right. So that is all. With this, we have completed the unit 3 as well. Any doubts, any queries, any questions till here? The difference between retail and corporate banking. Any questions? If you have, then you can ask. And then we'll start with the unit 4. Everyone who's present here, in the meantime, you can also like the video, share the video. Everything is clear till now, everyone? No doubt, all right? Great. These topics are simple, right? Clear? RBWM is comparatively easier as compared to your previous papers. No, module A is not at all enough for examination. No. You have to study module B and module D thoroughly. Only 10 to 15 marks questions will be asked from module A. Whatever we are studying from module A is enough for the 10 to 15 marks that will be asked in the examination, but not for scoring 50 plus. All right? So let us move on to the unit 4. Segmented approach to retail banking. Segmented approach means smaller, distinct subset, right? Based on any decision, the branches are segmented. They are divided. The models are divided in banking, dividing the customer base into smaller, distinct group, or dividing the branches into smaller, distinct branches. That would be the segmented approach. All right. It could be maybe dividing the organization, focusing only on retail or mid corporate or high net worth individual, right? Segmentations. Okay. Now let us move on to the unit 4, which is the most important unit from the module A, and very simple, easy scoring numericals are also asked. 2 marks numericals that are very, very extremely easy numericals. Okay. So let us start. Okay, banking system and introduction. First of all, an introduction is given to you, how banking system organized or evolved in India. So there are two acts, the Banking Regulation Act of 1949 and the RBI Act. Both you have studied in your PPB paper, right? Under the Banking Regulation Act, the definition of banking is given under section 5B, and then the prohibited business, permitted business. In IE and IFS also you have studied. Under the Reserve Bank of India, the reserves that have to be kept, new branch requirement, these are there. So these two acts basically govern the banking business in India. Originally, the name of the Banking Regulation Act was the Banking Companies Act of 1949. Why? Because corporative banks were not included under the purview. But later on, from March 16, 1949, the name was changed. It was changed from March 1st, 1966 into the Banking Regulation Act of 1949. So original name of the act was Banking Companies Act of 1949. Then in 1966, the name was changed to the Banking Regulation Act of 1949 when corporate banks were included. Now the development of banking sector we see through three phases. First is the early phase, 1770 to 1961. There were more than 600 banks in India, but out of these 600 banks, only a few survive today, right? Second phase is the nationalization phase, where in two phases, 14 banks and another 6 banks were nationalized. They were turned into the public sector banks. And then came the third phase, which is the liberalization phase, the banking reforms phase from 1991 onwards, where the recommendations of the Narsimham Committee 1, Narsimham Committee 2, Rangarajan Committee, they were followed. So these are the three phases of banking development in India. Prior to independence, in the first phase, 600 banks were there. Many mergers were done, like the three presidential banks of India, Presidential Bank of Calcutta, Bombay and Madras were merged as the Imperial Bank of India in 1921, pre-independence. And then the Imperial Bank of India was later nationalized in 1995 and named the State Bank of India. Over the time, the 7 subsidiaries of SBI have been merged. Completion in 2070, right? Then came the second phase, which was the nationalization phase. The government decided in this phase, the government took over the various private banks that were operating in India. So 14 banks were nationalized in 1969, and then in 1980 another 6 banks were nationalized, right? 7 subsidiaries of SBI were nationalized, later merged in with SBI. So nationalization took place in 1959 and they were later merged with SBI over the time. Okay, so this is the second phase. Final phase, in the 90s, government set up the Narasimham Committee to manage the major reforms in the banking sector. What were the recommendations of the Narasimham Committee? IE and IFS recall. CRR, SLR was reduced. Prudential norms were introduced. Supervisory norms, legal institutions were set up, right? Now, private sector banks and foreign banks were also allowed to function in India. Few private sector banks have emerged amongst the biggest banks in the country. So this was an introduction. Do not leave the session. Do not leave the session right now. Even if you are tired, bear for just half an hour more. We will practice some questions from the module A. In the end of the session, we'll be practicing some questions, numerical questions as well. So don't leave the session right now. Okay, now we come to the most important part. What is profit and what is profitability? If you set up a business, doesn't matter how small or how large it is, the main aim of any business is to generate profit. What is profit? It is the total revenue minus total expenditure. We can say that, right? If let's say I had to spend 10,000 rupees in a business, right? And spending those 10,000 rupees, I was able to earn 15,000 rupees. So what is my profit? 15,000 minus 10,000, my profit is rupees 5,000 rupees. Okay, that is profit. Profit is the absolute number, the absolute money, absolute number that an organization pulls in from the business, from its activities. Profitability, on the other hand, is a separate concept. Profitability is a relative concept. Relative concept, it is a comparison. I compare this 15,000 rupees with the 10,000 rupees that I had to spend, right? If a friend also started a similar business and to generate this 15,000 rupees revenue, they had to spend only 7,000 rupees. But what happened here? They will be more profitable. Or if let's say they also spent 10,000 rupees but they were able to generate 18,000 rupees, they will be more profitable. So profitability means that efficiency. How efficient an organization is, how cost effective an organization is. So profitability is the measure of an organization's profit relative to its expenses. Efficient organization will be able to generate more profit as a percentage of its expenses. A less efficient organization will have to spend more to get the same level of profit. So profitability is the measurement of efficiency, ultimately the success or failure of an organization. Profitability, it could be the ability to produce a return on an investment. We compare the investment returns of one organization with the investment and returns of another organization, or we compare the investment strategy, one investment strategy with another investment strategy. So profitability is a relative measure of profit. We compare how much a company can make profit is as compared to its overall revenue and cost. The profitability concept compares how much profit a company makes compared with its overall revenue and cost. So profitability gives us the measure of efficiency, holistic view, a complete picture of the efficiency of organization. Profit is simply the money a business pulls in after accounting for all the expenses. The primary goal of any business is to earn money, right? So profit is an absolute term. Profitability is a comparative term. It is a relative term. All right. So the difference between profit and profitability is clear. Is there anyone who has not understood the meaning of profit and profitability? If it is clear, then we will move on to the formula, the numerical part. Right? So when we talk about profit or profitability, some of us, we focus only on the top line profitability, gross sales. Others, they focus on the profit which is generated after accounting for all the expenses. Expenses means the selling and general cost, packaging cost, taxes, interest. That is known as the bottom line profit, right? So we have three levels of profit or profitability: gross profit, net profit, and operating profit. So remember the difference. Profit is the absolute term, exact money a company or a business makes. Profitability is a relative term, right? Now, when we are talking about gross profit, the first level of profitability is the gross profit. Remember the formula. I've included the table at the end of the PDF. You'll get all the formula in one picture in one slide. So, gross profit is equal to total sales minus cost of goods sold. So what did we calculate? The gross profit is equal to total sales was of 15,000 rupees. Cost of goods sold was of 10,000. So gross profit is 5,000 rupees. It is the first line item. When we prepare the balance sheet, right? The first thing that we put is the sales. Below it on the income statement, we have the cost of goods sold, right? So subtract the cost of goods sold from the total sales, you'll get the gross profit. How do you calculate the gross profit margin? Divide the gross profit by the total sales. So divide 5,000 by 15,000. You will get the gross profit margin. Alright. So gross profit is total sales minus the cost of goods sold. Gross profit margin is the gross profit divided by the total sales. Okay, that is the gross profit margin. Operating profit is the second level of profitability. First level of profitability is gross profit. Second level of profitability is operating profit. So from the gross profit, subtract the selling, general and administrative cost. When when they ask you a numerical question, they will give you all the values. This is the total sales, this is the cost of goods sold, this is the SG&E. All you need to do is remember these simple formulae and you will be able to calculate it. So gross profit looks at the profitability after direct expenses, right? Operating profit looks at profitability after operating expenses. Selling, general, administrative costs. What the institute had to occur, what the organization had to occur on the selling of it, advertisement of it, administration cost, packaging, etc. That comes under the SG&A. So operating profit is equal to gross profit minus operating expenses, and operating profit margin is equal to operating profit divided by the total sales. Operating profit divided by the total sales. So let's say the SG&A was 3,000 rupees. So gross profit was 5,000 minus 3,000. 2,000 rupees is the operating profit. Divide the operating profit by the total sales, 2,000 divided by 15,000. You are going to get the gross profit margin, right? Divide the operating profit by the total sales, you'll get the gross profit margin. And the final level, third level of profitability is the net profit, which is the income left over after all the expenses. Apart from the investment, apart from the selling general cost, the organization also has to spend on paying taxes to the government. If they have taken a loan, they'll have to pay interest on the debt. So when from the operating profit, you subtract the taxes and interest, the final money left with the organization is known as the net profit. So from the revenue, subtract cost of goods sold, you will have gross profit. From gross profit, subtract the operating expenses, you will have operating profit. From operating profit, subtract the taxes and interest, you will have the net profit, which is the bottom line. So top line, gross profit. After that, operating profit. Bottom line or third level of profitability is the net profit. How will the institute ask you question? They will ask you to calculate all the levels of profit. They will give you all the values. All you need to do is remember these very simple three formula. I don't think it is difficult to remember, right? Gross profit, total sales minus cost of goods sold. Operating profit, gross profit minus SG and A. Net profit, operating profit minus the interest and taxes. How do you calculate the margins? Gross profit margin is equal to gross profit divided by total sales. Operating profit margin is operating profit divided by total sales. And net profit margin is the net profit divided by total sales. All right. So these are the three levels of profit. Now, these are the generic methods, right? The easier method. Another numerical portion is the traditional methods of profitability, in which we use the return on asset and return on equity concept. Return on asset and return on equity concept. Asset is the loans, the various loans that the banks give on which they earn interest. Equity is the bank capital that the bank is using to generate profit. Again, very simple direct formula that you need to remember. How do you determine the return on asset? The amount of income that the bank earns on its net interest income and fees on its services. Net. Banks, they earn interest on asset, but they also have to pay interest on the liability product, the various deposits, the CASA deposit and the fixed deposit. Bank, they also have to pay the interest. That is why we use the term net interest income. So net interest income depends upon the difference between the average interest rate received on asset and the average interest rate paid on liability. So if the bank is paying average, if they are getting average rate of interest on the loans at 10% and they have to pay 7% on its liability, so the interest rate spread will be 3%, right? So the average interest rate received on assets minus the average interest rate paid on liabilities is the interest rate spread, which is also known as the interest spread. Now, how do you calculate the net interest income? Interest received on asset minus the interest paid on liability. What are the assets? Interest earned on securities and loans. Asset include the securities in which the banks have invested and the loans that are given by them. The numerical portion isn't much. In November, only 5 to 10 marks numericals were there in your exam. Only 5 to 10 marks numericals were asked. Okay. So the net interest income is interest earned on securities plus loan minus the interest paid on deposits and borrowings, right? Interest rate margin. What does the interest rate margin show? If the bank is able to charge a higher rate of interest on the asset as compared to the interest that they have to pay on liability, then we can say that the bank is profitable. So net interest margin is equal to net interest income divided by the average total asset. Net interest income divided by the average total asset. So remember this. These are three different concepts. Net interest rate spread is average interest rate received on asset minus the average interest rate paid on liability. Net interest income is interest received on assets minus interest paid on liability. And net interest margin is where you divide the net interest income. You calculate the net interest income using this formula and you divide it by the average total asset. What is the meaning of average total asset? It is the asset in the beginning of the accounting year plus the asset at the end of the accounting year divided by 2. Accounting year or fiscal year. All right? No worries, it's okay. Now, once you have the net income, you have calculated this net interest income, divide it by the average total assets, you will have the return on assets. Divide the net income by the average total assets, you will have the return on asset. So, interest earned on securities plus loans. Interest earned minus interest paid divided by the average total asset will give you the return on asset, right? So return on asset is equal to fee income plus net interest income minus operating cost divided by the average total asset. Fee income plus the net interest income minus the operating cost divided by the average total assets will give you the return on assets for the banks. This is formula number 1, or we will say formula number part number 1, return on asset. Another concept is the return on equity. Now, average total assets, why are we using average total asset? Because income is calculated over a period of time. So, total assets at the start of the fiscal year plus the total assets at the end of the fiscal year divided by 2. This will give you the average total asset. Institute will give you all the values, interest earned, interest paid, everything. Right? Interest paid, everything. Okay. Next, we have the return on equity. Equity is the bank's investment, the shareholders, the bank owners, how much they have invested their money. This is what they are primarily interested in. Why? Because their earnings will not depend only on the return on asset, but also on the total value of the assets that earn income. If the owners want to earn a greater return, they would use their liabilities rather than their own capital. Liability means the deposits that they are creating, or they can also take loan. But they will not use their own capital. Otherwise, if there is a liquidity run, the whole capital of the bank will be deteriorated. That is why if banks want to create more returns, they will give more deposit and they will use those deposits to give out more loan. Okay, so that is the return on equity. When a bank is increasing liabilities, it is using leverage. Okay, but RBI has fixed the leverage ratio. Banks also cannot accept easy deposits. Banks, they have to follow the KYC AML norms. Interest rate spread is also limited by what a bank must pay. Below that, the banks cannot offer the customer. That is why liabilities also the banks can increase only up to a certain limit. Why? Because RBI regulates it. RBI does not fix the rate, but they regulate it. Banks, they have to fix it according to the external benchmark or the MCLR, whatever is stipulated by RBI. Okay, so banks can charge for their loan only so much that is allowed by RBI and the market, and the banks can also offer the deposit, interest on deposit, only up to the limit they are allowed. So the net interest spread are limited. Okay, how can they create more return? By increasing the leverage. Now we come to the formula that you need to remember. Leverage ratio is the bank assets divided by the bank capital. How many assets have been created by bank? How many loans have been given by banks in comparison to its bank capital? This cannot be very high. The leverage ratio cannot be very high. That is what happened with the subprime mortgage crisis, the Lehman Brothers crisis. They gave two easy loans, very easy mortgage term loans. Most of the borrowers, they defaulted and the bank capital was completely demolished. So the leverage ratio can also be increased only up to a certain limit. What is the formula for leverage ratio? Bank assets divided by the bank capital. Now, you can very easily calculate the return on equity. Simply return on assets multiplied by the leverage ratio will give you the return on equity, right? If we expand this formula, what is the formula for return on asset? It is the net income divided by the bank asset. Leverage ratio, we just studied its formula. Bank asset divided by the bank capital, right? Cancel out bank asset on both the sides. You will have net income divided by the bank capital. So both the formula will give you the same answer. If you have already calculated the return on asset and the institute has also asked you to calculate the return on equity, all you need to do is multiply it by the leverage ratio, or you can use the formula of net income divided by the bank capital. Net income divided by the bank capital. Okay. Do not worry about the formula. We will practice questions on it and then you'll understand how easy the numericals are. I will tell you two mark numericals are asked, just one line numerical. Institute will tell you this is the bank asset, this is the bank capital, this is the interest. Calculate the ROA or calculate the ROE. All you need to do is simple addition and subtraction. We will practice some questions on it. Now, what are the factors that affect profitability of bank? Some macroeconomic factors like GDP growth and inflation. If there is very high inflation, then it would lead to low profitability. But if GDP growth is there, then there will be high profitability. Industry specific factors are there. If the bank's non-performing assets are increasing, the profitability will reduce. If the banks are able to recover their loans, the profitability will increase. Other bank specific factors, if the banks are able to pay less interest on their deposit and they're able to charge higher interest on their asset, then the profitability will increase. If the bank are able to offer more fee based product, so they can earn commission income, service charges, guarantee fee, right? Then also the profitability will be increased. And that is all. With this, we have completed the unit 4 as well. The whole module A is complete in one session. All right. Now this is the table. Like I told you, all the numerical formula I've included in one slide. Gross profit, operating profit, net profit, gross profit margin, operating profit margin, net profit margin. How do you calculate the asset, interest rate spread, net interest income, net interest margin? Using that, calculate the ROA, ROE, leverage ratio, and the average total asset. So if you want, you can write this down in a proper piece of paper, stick it on the wall wherever you are studying, and just go through the formula. Just remember the formula. All right? Done. Now let us solve some questions from our module A. Are you ready? Are you ready to answer some questions from the module A, the chapters that we have completed? Yes? Okay. First question. Identify the correct statements regarding the evolution of retail banking. Retail banking begins with mass retail and evolves into class retail banking. Private banking is a form of mass retail banking. Class retail banking involves standardized products for the generic public. Mass retail banking helps build a stable funding base. I want all of you to answer this question. Statement option A is 1 and 4 only, option B is 2 and 3 only, option C 1, 3 and 4, or option D 1, 2 and 4 only. What will be the correct answer? Everyone. YouTube, all those who are watching on the YouTube, please answer the question. Okay, Naveen C. Krishna is saying A. So what will be the correct answer? Let us go through the statements one by one. Retail banking begins with mass retail banking, evolves into class retail banking. True. But private banking is not a part of mass retail banking. It is a form of class retail banking. When the banking products and services are offered only to the high net worth individuals, then it is known as private banking, right? So the second statement will be incorrect. Third statement says class retail banking involves standardized products. No. Mass retail banking provides standardized products and services to the general public. Class retail banking offers customized, tailor-made products and services to the unique customer segment, high net worth individuals. So the third statement is also incorrect. Fourth statement, the purpose of mass retail banking is to help build a stable funding base is correct. So the correct answer is option A, 1 and 4 only. Everyone who has answered A, correct. Those who have answered C, is the concept clear now? Is the concept clear now? Naveen, is it clear? Is it clear? Why only 1 and 4 is correct and 2 and 3 is incorrect? Third statement is saying class retail banking involves standardized products. Recall the very first slide of today's session. We start with mass retail banking. Mass retail banking offering standardized generic products to all customers, building a strong customer base, a large customer base, getting a strong funding. That is mass retail banking. Then we evolve into class retail banking. From the large customer base, the high net worth individuals are identified. And then tailor-made services like portfolio management, tax planning, investment management is offered to them. That is class retail banking. So class retail banking involves customized products for the high net worth individuals, the unique customer segment. Clear now? Amit, why statement 3 is wrong? Clear now? Class means first class. That could be a good way to remember. Next, which of the following is not typically considered a para-banking product offered under retail banking? Which of the following is not a para-banking product offered under retail banking? Insurance products, capital market products, credit cards, or treasury bills for institutional investors. Which of the following is not? So banks, they offer multiple products, right? Liability side, asset side, and para banking. So which of the following is not a para banking? D. Yes, the correct answer will be D. Why? Because treasury bills are typically offered to institutional investors. They fall outside the scope of retail banking. Everyone answered correctly. Great. Parabanking are the third party product. Insurance product, mutual fund product, these are parabanking. Numerical question. A bank has net income of rupees 40 crore, bank capital of rupees 200 crore and bank assets of 2000 crore. What is the return on equity for the particular bank? So you have been given the net income, bank capital and bank asset. Calculate the return on equity. Calculate the return on equity. So what is the formula for return on equity? Can you use the direct formula for return on equity? It is net income divided by the bank capital, right? It is net income divided by the bank capital. B 20B. Yes, the correct answer will be B 20%. So we can calculate it using both the methods, ROA multiplied by leverage ratio and the direct formula as well. So first, if you calculate the ROA is net income divided by the bank asset. Net income is 40, bank asset is 2000, right? It will give you 2%. 2%. Okay. And you can also calculate the leverage ratio. Bank asset is 2000 crore divided by the bank capital is 200. Cancel it out. You will have 210. 10%. If you multiply it, then also you'll get 20%. Or simply use the direct formula for ROE. What is the direct formula for ROE? Net income divided by the bank capital. Net income divided by the bank capital. So 40 crore divided by 200. Cancelled out 1 by 4, 20%. Yes, everyone agrees with answer B. Everyone has understood the calculation like this, one liner, and trust me, this will be a 2-mark question. If you are able to get it right, you will get easy 2 marks on this numerical. Great. Let us move on to the next question. A sudden loss of depositor confidence in a retail bank may lead to credit crunch, liquidity surplus, bank run, or interest rate hike. If the depositors lose confidence in a retail bank, what will happen? All of them will go to the bank to withdraw their deposits, right? But the bank would have used these deposits to give up, and they have given out loans. So that would lead to a bank run, right? It is a type of risk that the banks have to manage. It is a type of risk that they have to manage. A large number of customers simultaneously withdraw their deposits from a financial institution due to fears of insolvency, right? Banks, they operate on a fractional. They only have to keep a small portion of deposit. This would make them vulnerable to a sudden mass demand for funds, and that is known as the bank run. Bank run. Okay. Here's a case study. A mid-sized bank launches a new retail loan product targeting salaried professionals. The product promises instant approval, flexible repayment, and bundled insurance. However, the fine print reveals high processing fees, mandatory cross-sell of third-party insurance, and steep penalties for delayed EMI. Within 6 months, the bank faces backlash. Customer rights NGO files a complaint. The bank's internal compliance team argues that all terms were disclosed in the loan agreement, while the marketing team insists that aggressive pricing was necessary. Meanwhile, the regulator has initiated a probe. Regulator is the RBI. Which of the following best explain the regulatory and strategic risks involved? Fairness and transparency in pricing are critical to avoid customer protection violation. Bundle products must be clearly positioned, not forced through cross-selling. Disclosure alone does not absolve the banks from responsibility if the pricing is exploitative. Short-term sales targets can justify aggressive pricing strategy. So like this, lengthy case studies are asked. Let me just hide this. Yes, so the options are option A, 1, 2 and 3, option B, 2 and 4, option C, 1, 3 and 4, or option D, all of the above. What will be the correct answer? Everyone. Everyone answer this question. The types of risks involved are option A, 1, 2 and 3. The statement 4 says that short-term sales target can justify aggressive pricing. No. In retail banking, aggressive pricing is not justified. Here, high processing fees is involved. High processing fees, steep penalties for delayed EMIs cannot be charged by the bank. All right. That is why only the option A, 1, 2 and 3 will be correct. Next. Which banks were pioneers in introducing the consumer banking models in India? Which banks introduced the consumer banking model in India? State Bank of India and Bank of Baroda, Citibank and ICICI Bank, Standard Chartered Bank and Grindlays Bank, or Indian Overseas Bank and Andhra Bank. Which banks set the trend of retail consumer banking models in India? What will be the correct answer? No, you were right before. Banks that set the trend were the foreign banks, Standard Chartered Bank and the Grindlays Bank. If the question was asked about Indian banks, then you could have answered SBI, BOB, or Citibank if the credit card question was there. But the question says pioneers of introducing consumer banking model in India. So that would be Standard Chartered Bank and Grindlays Bank. The foreign banks set the trend of retail banking or consumer banking in India. All right. Next. What role did Citibank play in shaping retail banking in India? What role did Citibank play in shaping the retail banking in India? It introduced banking services focused on corporate clients. It pioneered the hybrid liability products for small businesses. It focused on institutional lending rather than personal banking. It revolutionized the retail banking space with credit card operations. So the Citibank is associated with the credit card operation. Yes, the correct answer will be option C. Citibank is associated with the credit card business. Option D. Option B. Everyone is answering option D? Yes, correct. Next. Which public sector banks? Now you answer this question according to the public sector banks. Which public sector banks were the early players in the credit card business in India? Public sector banks. Punjab National Bank and Canara Bank, Bank of Baroda and Andhra Bank, ICICI Bank and HDFC Bank, or RBI and NABARD. Which public sector banks were the early players in the credit card business in India? They were the Bank of Baroda and Andhra Bank. Alright? Bank of Baroda and Andhra Bank. Public sector banks. Correct. Next. Another case study based question. A private bank launches a new housing loan product with extended repayment terms of up to 30 years bundled with furniture financing and insurance. Housing loan comes with furniture financing and insurance. The product is aggressively marketed to young professionals with minimal credit history. They do not have a good credit history. Within a year, the bank sees a surge in loan disbursement, but also rising delinquencies among borrowers who underestimated the long-term obligation. The regulator flags concerns about over-leverage and inadequate risk disclosures. Which of the following statements best explain the ethical and strategic implications of such retail lending practices? Longer repayment terms increase financial leverage but may obscure long-term affordability risk. Bundled retail loans must be transparently priced and clearly communicated to avoid consumer protection violation. Young borrowers with limited credit history are ideal targets for high-value retail loans. Retail loan growth must be balanced with responsible lending and borrower education. What will be the correct answer? 1, 2 and 4, 2 and 3, 1, 3 and 4 or all 4? What will be the correct answer? So the first statement is correct, right? Longer repayment terms increase financial leverage, but affordability risks are reduced. Bundled retail loans should be clearly communicated. Anything should not be forced on the customer. However, young borrowers who do not have a good credit history should not be ideal targets because there will be chances of higher delinquency. Higher delinquency. So the correct answer will be option A. 1, 2 and 4. Who has answered 1, 2 and 4? Naveen, Abhi, yes. Alright. 1, 2 and 4. Okay. Next question. What are the characteristics of the units covered under the SBU approach? Very important question. SBUs are autonomous divisions. They are small enough to be flexible. They are large enough to exercise control over most of the factors affecting long-term performance. SBUs can be defined as profit centers which focus on specific product offering only. Which of the following are features of the SBU approach? Option A, 1, 2 and 4. Option B, 2 and 4. Option C, 1, 2 and 3. Or option D, all of the above. Which of the following are features of the strategic business unit? Features of the strategic business unit. D, yes. So the correct answer will be option D. All of the above are correctly defining the SBU approach. Profit centers are set up, management by objectives, independent unit, focus on a particular product offering, and they exercise control over all the factors. Last question, one more numerical. A company has a gross profit margin of 30% and sales of 1 crore and 20 lakhs, right? Right? What is the cost of goods sold? Take your time and then answer the question. You need to go in the reverse direction. Already the gross profit is given to you 30%, right? And sales is given 1 crore and 20 lakh. Already it is given to you. First, you need to calculate the gross profit. So, how do you calculate the gross profit margin? Gross profit margin is equal to gross profit divided by the total sales. So, 30% is equal to, let us say, X. X is the gross profit divided by the total sales. Calculate it. You are allowed to take calculators in your exam. You are allowed to use your calculators in your exam. So basically what you need to do is calculate 30% of the total sales that is given to you, which will come out to be 36 lakhs. 36 lakhs. Calculate 30% of 1 crore and 20 lakh. It will come out to be 36 lakhs. Once you have the total gross profit, you can calculate the cost of goods sold, right? Simply from the sales, subtract the gross profit, right? Gross profit, formula for gross profit is total sales minus cost of goods sold. So take the cost of goods sold on this side. Cost of goods sold will become gross sales minus the gross profit. Total sales minus the gross profit. What will be the correct answer? Yes, the correct answer will be option C, 84. All right. 84 lakhs will be the correct answer. This is the cost of goods sold. So gross profit is equal to 30% of the total sales. From that, the same formula is used. Gross profit is equal to total sales minus cost of goods sold, and gross profit margin is equal to gross profit divided by total sales. We just rearranged the formula a bit to get the answer. We have just rearranged the same formulae that we have studied. All right. So that is all for today. With this, we have completed the whole module A. Now download the PDF. The 360-degree kit is also available for you. Those who are there in the capsule batch in the paid platform. Go through the PDF, revise the theory. You have full-length mock tests also available. Practice those tests. If you come across any doubt, any question, then you can ask me tomorrow. Tomorrow also we'll be having class at the same time, 7 p.m. and we'll be starting with the module B. All right. And those who have attended the session on the YouTube, tomorrow also we'll have the class on YouTube, but we'll only complete half of the module B. Remaining everything B, C, D and E will be doing on the capsule batch. So join the capsule batch, right? This is the link to the Telegram channel. If you have not yet joined the Telegram channel, make sure that you join it. You'll get daily quizzes, all the important updates, YouTube class updates, everything. So everything that we have covered today is clear. Did you like the session? Did you find the first module easy, module A? Do give me your feedback and rating. The feedback option is there on your screen. You can give me your feedback about the class. And this is the Telegram channel for the official Oliveboard. Telegram for official Oliveboard. All those who are there on the YouTube, like the video, share the video. And I'll meet you tomorrow at 7 p.m. and we'll start with the module B. Alright? So let us wind up the session then. Do give me your rating and feedback, everyone. Thank you so much. Good night. Take care and all the best.